European debt concerns back on the front burner. Yields on the Irish 10-year bond hit 7.87% today. That is the highest since 1996. And over in Portugal, yields hit 6.74%. That's the highest since 1997. The yield spread between Portugal and the benchmark German Bund rose to a new record. So, in contrast, some good news out of Greece, because yields there are falling after voters gave the government a victory in local elections, giving Prime Minister George Papandreou more flexibility to push spending and wage cuts through. Joining us from London this morning for What's Ahead is Jan Randolph. He's head of sovereign risk at IHS Global Insight. Jan, thank you for joining us. I guess the question that everyone wants to know and maybe afraid to ask is whether Ireland is going to be the next Greece in need of a bailout.
Yes, it's a very important issue. Just as when we thought things were getting better managed with this backstop facility that was organised back in May, June, at the height of the crisis, we're now entering potentially another dangerous round. And that's mainly driven by this debt restructuring proposal pushed by Germany, Angela Merkel, at the last Brussels summit last week. It's less to do with the stability of the governments involved. It's more to do with this debt restructuring plan.
It's basically Angela Merkel leading an effort to stand up for German taxpayers and say no more. What does that mean for bondholders then, Jan?
Well, essentially what it does, if you take the perspective of German taxpayers and the German government, they are always called in at the last moment, at the end, at the height of the crisis, to come in and save the situation. And the way they do that is to provide, the German government's balance sheet and the taxpayer to effectively guarantee, private guarantors to ease the situation as far as investors are concerned. They've done that with the big backstop package now in place for Greece, Spain, Greece and Portugal. But they resent it. They don't like being used like this, and they're trying to shift the balance of risks back onto the investor.
Mm-hmm. Now, with this, go on, I'm sorry.
Yeah, I mean, the Germans say this is we cannot have a situation where investors are playing moral hazard with German taxpayers, and if we do have in future a sovereign debt crisis, then investors have to understand those risks at the point of making their investment, rather than expecting the sovereign to come in and bail everyone out.
Right. Well, given where yields are right now in Ireland and Portugal, are the current price movements justified?
Well, what's happened essentially, and Jean-Claude Trichet pointed this out once this debt restructuring proposal went through at the last Brussels summit, he says this will raise borrowing costs, and that's what we've seen. It effectively entrenches these spreads, what I call country risk spreads, that are being imposed on Ireland, Portugal, Greece, and to a certain extent, Spain. The whole point about the debt restructuring proposal is that in future, borrowing costs will better calibrate with the underlying credit risks. That situation disappeared in the go-go years as more and more countries joined the European Union and the Euro group. Financial markets, basically the spreads came down and there was hardly any interest rate differential. Now there is. The situation is going to get entrenched should this debt restructuring proposal come through.
Jan, are we going to see European debt concerns overtake and snuff out the U.S. recovery like we did last summer?
Well, I mean, that may be a bit arch. I mean, there are a lot of factors to factor in, countervailing ones, mitigating ones. What the U.S. is trying to do, obviously, is trying to resuscitate, reflate the economy with an extra dose of monetary easing. That, in some ways, is supportive of asset prices over here. We've seen equities go up. The pound went up very strongly. Equity prices came up here. And even certain sovereign bonds, there's a lot more supply now to buy sovereign bonds. But the point is that sufficient to counteract the real risks that exist in Spain, Ireland and Greece?
Okay, I guess we could be talking about this for months to come, but that's all the time we have right now. Thank you so much, Jan Randolph, the Director of Sovereign Risk at IHS Global Insights in London.